like I said, the capital asset pricing model, has different variations of it, and there are different ways that it's looked at. It has evolved over time pretty substantially towards far more sophisticated understandings of what is going on in the marketplace. We have our own our own evolution of this understanding. Some of you who are on this call have seen something like this before, that we've talked about this in previous sessions, but I wanted to talk about it a little bit here because I think it is really a more accurate reflection of what is actually happening in investor portfolios in the marketplace, which is breaking down investment portfolios and conceiving them at a level of risk premiums and investment methods. So, as I've spoken about before here, as a firm, and we actually have a white paper out on this, that was published almost 2 years ago at this point, that goes in great detail on this, and we're actually going to be doing a revised version of that in the near future here, to update it and include some additional insight that was not in the original version that we've actually already implemented with people's assets. But talking about investment methods and risk premiums, so you can further break down that efficient frontier I talked about earlier into additional or subcomponent premiums or additional premiums other than that basic market risk premium that we talked about, right? And really that changes, if you do it that way, it changes your whole outlook on how you should manage an investment portfolio. So let me show you what I mean. All right, so if I go in, we'll skip this and go to this. All right, so this looks similar in concept to that that efficient frontier graph I showed you earlier, right? But there are some differences here. What we've done here is broken down we've eliminated the concept of the risk-free rate because, quite frankly, it does not exist, right? And I think right now there is proof of that in the marketplace, because the rate of return on treasuries on a real basis after inflation is actually negative right now, and even on a nominal basis, if you look at treasuries of places like Europe and in Japan, it's it's even on a nominal basis it's zero, right? So and these are in theory the risk-free rates. So the risk-free rate, that's probably what the risk-free rate is. If you take no risk, you get no return. It's zero, right? So that's so instead of calling it the risk-free rate, we call it, here's an abbreviation for it over here, the credit default risk premium, right? The credit default risk premium, right, is the returns you can extract from the marketplace by taking on credit risk. But what do you mean by credit risk? As an example of credit risk is you make a loan to a corporation or a government or a municipality in the form of buying a bond from them, and they guarantee you, it paying back a certain rate of interest on that bond if you hold it to maturity. So that is it's a fixed rate of return, right? But it's not risk-free. There is a risk of default. They can default on that loan and become unable to pay you, and then your investment is lost. So it is not a risk-free rate, right? It is a risk premium, a credit default risk premium, right? So, and that credit default risk premium can vary, pretty widely, and you can actually choose your risk premium, right, by choosing, for example, a mix of different types of bonds or insurance contracts or derivatives contracts, right, that return a certain rate. So, for example, you could use short-term treasuries and your CDRP would be down here, or you could use high yield bonds and your CDRP would be up here. You could use a mix of a variety of different, would probably be somewhere in between these, right? You still got a lot of tangency like on the other ones, but you notice here, importantly, there's not just one risk premium, right? There are three additional in addition to this CDRP. So you've got a fixed risk premium in the CDRP, and then you got three variable risk premiums that will change quite frequently on a minute by minute basis. So what we call the systemic efficiency risk premium is the same. This is that same graphical line you saw earlier on the original efficient frontier, right? Where you've got it's based on exposure to a diversified portfolio of assets. The more diversified your portfolio of assets is, the closer you can get to this line, and the closer you can get to that theoretical, ideal market portfolio, which would be here, right, at that point of tangency. Now, what we've identified in addition to those, though, are two additional risk premiums. We have what's called the cyclical inefficiency risk premium and the structural or secular inefficiency risk premium. All right, the cyclical inefficiency risk premium is the returns you can extract from the marketplace by trying to take advantage of market cycles and changes in the market, right, on an active management basis by tactically manipulating the portfolio and actually changing your asset allocation, right? It's basically tactical manipulation of a portfolio, which can take the form of market timing, right? So rather than say that market timing has no place in a portfolio, you can also say that market timing is something that can be taken advantage of if it's done well, right? It's extremely difficult to do, but if it's done well, it could potentially be taken advantage of. That creates, you can graph that just like you can these other asset types, but you can graph those different strategies on here, and you can create your own additional efficient frontier, right? This additional risk premium. The same thing goes for what's called the secular inefficiency risk premium, which is you can achieve additional returns by taking on the risks associated with selecting individual securities, security selection risk. So basically, I mentioned idiosyncratic risks earlier, right? By buying individual stocks and just doing that, then you've got idiosyncratic risks that can be diversified away. Yes, they can be diversified away. They can also add to the value of a portfolio, right? If it's done right. That's the hard part, right? So that being said, so whether you do it right or not, right, is outside the scope of this conversation here, but it's something that can be graphed and added to this graph. And if you do that, you can actually push out. You can actually, there are points on this line. There's another line that should be drawn on here, but is not, that will run from this point here across the tops of these three lumps to push out the frontier and gain this space in between, right? And depending on where these lie at any given time, these curves, that space could be quite substantial. So this SIRP could be out here. This CIRP could be out here. And yet, while the SERP is here, at which point this pushes the line out much further, right? So it depends on where you measure these. This is probably a minimal, illustration of the increase you get. So what we're saying with this is, you can, by using not just strategic asset allocation, which is what is prescribed by modern portfolio theory, but also taking advantage of these other risks and the premiums associated with them by adding in the idiosyncratic risk, the security selection risks, and the market timing risks or tactical allocation related risks and manager related risks, you can actually improve the overall risk adjusted returns of the entire portfolio. So effectively what that means is by diversifying at not just by the types of assets that are used, like you would in strategic asset allocation or traditional modern portfolio theory, but by also adding on this additional layer of diversification by investment method, by using not just strategic asset allocation, but liability-driven investing, opportunistic investing, and selective concentrated investing, which are methods that can take advantage of those other risk premiums, then you can actually improve the risk-adjusted returns of the overall portfolio, right? And that's the methodology we use when we manage portfolios for our clients, right? So we believe that more sophisticated understanding of risk can actually reap rewards for the investor, and that's the way we do it.